recent column in Reverse Mortgage Daily asks, is there a better way to avoid reverse mortgage foreclosures? And my goodness, I hope there is, because the typical reverse mortgage foreclosure, when the last borrower passes, squanders three things: time, money, and also the value of the home, especially after mom and dad have passed away and their home is quote unquote being foreclosed on. They didn't do anything wrong. It's just the natural termination of a home equity conversion mortgage. And this is why Reverse Mortgage Daily interviewed Byron Batres of Scrivener, and just to learn a little bit more about what his company's doing and how they might be able to help solve what has been really a vexing problem in our industry. Now, there's a real challenge kind of pinpointing just how many foreclosures there are for HECMs. According to recent analysis in 2019 from the GAO, or the Government Accountability Office, and the Federal Housing Administration, they found that the percentage of home equity conversion mortgages, or HECMs, that terminated due to a default increased from 2% in 2014 up to 18% in 2018. Now, the borrower's death accounted for 30 to 40% of those defaults, and that's the real rub with foreclosures. In fact, my son and his wife bought a home that was his wife's grandparents', and they had a reverse mortgage, and it sat empty for over 2 years. Meanwhile, the home's not being air conditioned or heated in the different temperatures and weather you may have in Louisiana, and also thieves came and stole the condenser for the air conditioner so they could basically scrap any of the precious metals in there and copper. Happens way too often. So Scrivener is a 2-year-old company, says RMD, and they're looking to reduce the number of foreclosure outcomes. He spoke with Housing Wire and Reverse Mortgage Daily in an interview to kind of shed a little bit more light. So let's take a look at what he had to say. Mr. Batres is a CFP, or Certified Financial Planner, but most interesting is his recounting in 2012 when his wife's grandmother passed away, and he was nominated to be the executor. And he said anyone who's been in that role can say it's one of the worst things that can happen to you. I would agree. I've seen this happen to family members myself. And when you're the administrator, trustees, you're never asked your opinion on when a document is being drafted. Whatever it says, you have to execute it. Batres owned a company called Easy Probate, which he has since sold, and they saved over $45 million in legal fees for over 5,000 clients. And in that time, he encountered his first foreclosure due to the death of a borrower. And he figured out a way to get an emergency petition filed and a TRO, or temporary restraining order, which allowed the client to sell the home and to recoup that remaining equity in the property instead of losing it altogether in a foreclosure. And he makes an interesting observation, saying that the legal system, the family, and the mortgage lender, although you could say that they had the same goal, seem to be working against each other. And we thought that probate, instead of foreclosure, was a better solution. With probate, you maximize the estate assets, which means that you clear the creditors, you clear the administrative expenses, and you give maximum proceeds to pass on to the family. More specifically to reverse mortgage borrowers, Batres says that it's ideal to have a will or a trust or some sort of document that transfers on death. So the moment that they pass away, someone can step in quickly and be appointed and take charge of selling the home. And he outlines the timelines for this process on a HECM reverse mortgage as follows. You have 90 days before a default is declared, then another 90 days before the servicer is going to take action. If they do take action, there will be a hearing after another 90 days. So once the hearing happens, there will be a sell date, which is another 90 days. So beginning to end, death to sale, he says the fastest that process can take is about 280 days. And in the marketplace, he says it typically takes about 2 years, which, by the way, is exactly the timeline my son and his wife had in basically getting that property. It sat empty for 2 years, and they were able to purchase it in an auction. So this does hit very close to home for me as well. And here's the fee structure. They charge a $2,000 flat fee for the probate costs and attorney's fees, which I say seems very modest. And then they charge 20% on any funds that were advanced to stop the foreclosure. So if they advance $50,000 to pay off any arrears, the estate would owe about $60,000. Without doing that, the entire property would have gone to auction, which would mean they're only paying about $12,000 to save $100,000 in equity, which he says is a no-brainer. In fact, Scrivener can speed up that process from what typically takes 2 years to a 60-day time frame. So this is really, I think, a benefit for reverse mortgage borrowers' families and also for the program itself, rather than letting a property sit empty and deteriorate for 2 years. Presently, Scrivener's been speaking with mortgage lenders and servicers and trustees who are hired to do the foreclosure. He says, I wouldn't say they're afraid, but they have concerns about regulation in using their services. So this interview is conducted by Neil Pearson, who is the new news editor for Housing Wire's Reverse Mortgage Daily, and he's based in the Seattle area, which, by the way, is where the former editor Chris Clow is now working for Costco's Costco Connection. Home values are at record values, yet HECM endorsement activity has been quite lackluster in recent years, and now more reverse mortgage lenders are launching innovative home equity loans, but not necessarily reverse mortgage loans. In fact, last week we reported on Longbridge Financial's launch of their new HELOC alternative called the HELOC for Seniors. It does require interest-only payments, but they're fixed throughout the life of the loan based on the amount of money utilized. But it does represent something more important, a real evolution in the senior home equity market, and it stands apart from the traditional reverse mortgage model. Well, then last week, we see that American Senior Lending, a division of High-Tech Lending, announced the launch of their new first-lien position mortgage called Equity Select. So we're going to dive into the details, and we'll learn just a little bit more. So this is Dateline September 17th. American Senior Lending, a national home equity solutions leader, announced the launch of Equity Select, and it's a non-recourse first lien position home equity loan to help advance the financial flexibility of Americans in retirement. And this is quite a unique product. Basically, there are monthly payments required, and there are also built-in protections for aging homeowners in that the payments are capped. Borrowers can choose their monthly payment plan, and it can be as low as just 1% annually. So if you took out $300,000, that would be basically $3,000 a year that you would amortize out into monthly payments. Of course, those monthly payments are going to adjust if you take additional withdrawals from this particular loan. So if you're taking out chunks of money, that of course would adjust the minimum required monthly payment. But here's the protection against payment shock, especially for older homeowners on a fixed income. This product, Equity Select, has a payment cap. So even if interest rates were to go up substantially or the borrower draws their full credit line, there is a cap that they would pay on this particular loan. Similar to the reverse mortgage, it's a non-recourse loan, meaning that only the home itself can be used to repay the loan when it does terminate or it becomes due and payable. David Peskin, president and CEO of American Senior Lending, said that today's financial challenges in retirement require reimagined financial solutions built on choice and innovation. We reimagined asset-based lending using home equity and spent several years designing this product, and building a web calc to provide customized quotes within seconds. So this is a big move for American Senior Lending. This product may be very attractive for the older homeowners who have been looking at a traditional home equity line of credit, or HELOC, as the home is the largest asset for many older Americans, but this one avoids the payment shock that you find in a traditional HELOC. So here's an example from their pilot program. A 75-year-old borrower qualified for $300,000 in the Equity Select loan, but they only took half, $150,000 at closing. Their initial monthly payment was just $126 in the first month and will never exceed $391 over the next 40 years, which, by the way, is the term of the loan. Eric Ellsworth, Executive Vice President of Sales at American Senior Lending, said that Equity Select is about giving homeowners more choice after being forced into an either-or box for too long. And I couldn't agree more. We've really seen seniors say, well, I got to get a HELOC or am I going to get a home equity conversion mortgage? And the HELOC they don't want because of the burden of monthly payments. Perhaps they know about the payment shock. And when it comes to the HECM, there's always that real barrier or hurdle that you have to get over of the really high upfront costs, mostly due to the upfront FHA mortgage insurance premium. And then negative amortization isn't for everyone. Not every older homeowner wants to see their loan balance compounding each and every month. And here's a little more information from American Senior Lending's product page about the Equity Select. Of course, it's a mortgage loan. It has to be repaid. And the interest rate is going to be based on the SOFR, which is a secured overnight financing rate, and plus a margin. Now, the APR does exclude any loan fees, points, and any similar charges. However, making just the minimum payment may not cover, in some situations, the interest only that has accrued during a given month. So that interest, of course, would be added to the balance of the loan. And then there's a balloon payment due within 40 years. So that's the term of the loan. But again, withdrawals only during the first 7-year period. So you have a 7-year draw period. Plus, they do require at least an initial draw of 50% of the credit line or $75,000, whichever is greater, which would tell us that they need to have at least $150,000 available before they can actually qualify for Equity Select. So to wrap this up, as we see HECM endorsement volumes really stagnating in recent years, and the senior homeowner certainly not beating down the door to get a reverse mortgage, these reverse mortgage lenders are innovating and creating products that aren't not exactly a reverse mortgage. And so this is a very unique loan. If you want to learn more, you can go to the website. We've included a link in the show notes on this page. Newsweek's recent column addresses the recent reversal in many housing markets across the nation, saying that these markets combined have plummeted by billions of dollars. We're going to dive into the details, but first, let's talk about the present state of the housing market. So here's where we stand today. Nationwide home values are actually up modestly, about 1.7%. Now that's nationwide. Yet we have a handful of markets across the nation that are falling, and you as a reverse mortgage professional, of course, want to be mindful of which markets those are, since you are dealing with a very equity-sensitive loan. But look at this. Home prices nationwide are up by a staggering, and I would agree, it is staggering, 57% from early 2020. Of course, that's when the COVID-19 pandemic hit. And then there was a subsequent home buying frenzy fueled by who? Yes, the Federal Reserve. You can thank them for the run-up in home prices and what's going to follow. About $1.08 or 12.5% of that increase was due to newly built homes, while the rest came from the price appreciation of the existing stock over the past 5 years. So that's where we stand today. Yet, while home values have continued to grow modestly across many markets in the nation, those that actually had the biggest run-up in home prices, those boom towns, are now suffering some of the biggest corrections so far this year. The question is, why wouldn't we have home prices skyrocket since mortgage rates reached a low of 2 to 3%? And of course, that put the buying demand on steroids, and then we had a lack of inventory, which further drove up home prices. In fact, Zillow says that the pace of home values has grown nearly 3 times as fast as normal in just the last 5 years. So doing the simple math, if we have an average appreciation rate of 4% a year over 5 years, home prices should be about 20% higher, not 57 or 67% higher than they are now. The states that saw the biggest run-up in home values were California, Florida, New York, and Texas, and at least 3 of those are now seeing serious price corrections. So here are the states where we're seeing the biggest drop in home prices, and that would be California, Texas, and Florida. So New York actually has tighter home inventory, and that's really helping them stabilize their prices. In fact, they're going up modestly in the Empire State. But let's talk briefly for a moment about the specific metros where you're going to see home prices beginning to slip. That would be in the state of Florida, we have Tampa, West Palm Beach, Sarasota, Naples, Fort Myers, Vero Beach, and Daytona Beach. Now, some of those markets have actually seen year-over-year declines in home or median sale prices of 5 to 7%. Now, this is existing home sales. In Texas, home prices are now falling the fastest in the cities of Austin, Dallas, Houston, Killeen, and Fort Worth. Prices are also dropping on my state here in California, in the Bay Area, East Bay, Santa Cruz, and Napa, just to name a few. Now, reverse mortgage borrowers in those affected areas we just went through are going to have a little bit of a smaller equity cushion to pay off their existing mortgage if they have one, or fewer funds to utilize over the life of the loan. And in fact, those living in these declining markets could see a more conservative appraisal, especially if there are several recent comparable sales with lower sale prices. In conclusion, it's prudent to communicate the current state of the housing market when you're meeting with potential borrowers, just to make them aware, because many of them expect that their home values are always going to go up. And they have forgotten the last correction we had, where prices nationwide generally fell from 2007 to 2012, a 5-year period for that home price correction nationwide. So how would you identify the markets that are most vulnerable to a price decline? Well, here's some simple methods that you can employ. One is to look at areas with low inventory. Those are going to be more resilient, so you're going to have less to worry about there, such as in the Northeast or in the state of New York. However, vulnerable markets are going to show an increase in price cuts. The listing price is going to be reduced. So if you're seeing a lot of price cuts in your area, that tells you that something is afoot. But a real key metric that you can watch for is the area's median price to income ratio. So nationally, right now, the median sales price for a single family home is about 5.6 times the national median household income. And that's the highest on record, by the way. Now, the markets that are most likely to see a significant correction in prices will far exceed that ratio. For example, we have homes in San Diego right now. The median sales price requires about 9.6 times the local median income. That's just not sustainable. In Miami, Florida, for example, that ratio is 8.6 times the local median income. So those markets are likely showing signs of being inflated by speculation, investor purchases, low housing inventory, and inbound migration. So be sure to keep an eye on these particular real estate dynamics that we just listed, and it may help you better advise clients to prepare for a shift in home values that could affect both their equity cushion and also their eligibility for a reverse mortgage.